What if I told you that there's a secret 3-digit number that follows you around for your entire adult life? A number that can decide whether you get approved for that new apartment, what interest rate you pay on your car, and in some cases, even whether you get hired for a job. This number is your credit score, and understanding it is one of the most important steps you can take for your financial health. Before we dive in, please remember that this video is for educational purposes only and is not financial advice. My goal is to help you understand these concepts so you can make your own informed decisions. With that said, in this video, we are going to break down the 5 essential pillars that make up your credit score. I will provide a clear framework that simplifies this subject, and by the end, you'll have an actionable step you can apply immediately. We're going to demystify this number so you can take control. Make sure you stay for the final point, where I'll cover a common pitfall that trips up nearly everyone. Let's get started with the single most important factor. Component number 1 is your payment history, and it makes up a whopping 35% of your FICO score. This is the heavyweight champion of your credit. It's simple. Do you pay your bills on time? Lenders want to know that if they give you money, you have a consistent track record of paying it back as agreed. A history of late payments is the fastest way to damage your score. It's important to understand the levels of severity here. Paying your credit card bill 2 days after the due date will likely just result in a late fee from your bank. However, once that payment is 30 days past due, the creditor can report it to the credit bureaus. A 30-day late payment is bad. A 60-day late is worse. And a 90-day late is even more damaging. These negative marks can stay on your credit report for 7 years. Even worse are major negative events like bankruptcies, foreclosures, or accounts sent to collections, which can crush your score for a very long time. So here's what to do. Do this. Pay every single bill on time, every single time. The easiest way to ensure this is to set up automatic payments for at least the minimum amount due on all your credit cards and loans. You can always pay more later, but setting up auto pay is your safety net. Don't do this. Never miss a payment. Don't think that paying a few days late doesn't matter. While it might not be reported immediately, it's a bad habit that can lead to a 30-day late mark, which is incredibly damaging. And absolutely do not let an account go to collections. So, at 35%, payment history is all about consistency. It's the foundation of a good score. Now, for the second most important piece of the puzzle, accounting for 30% of your score, amounts owed, or as it's more commonly known, your credit utilization ratio. This sounds complicated, but it's actually very simple. It's the amount of revolving credit you're using compared to the total amount of credit you have available. Let's say you have one credit card with a $10,000 limit. If you have a balance of $3,000 on that card, your credit utilization is 30%. It's crucial to know that this is calculated in 2 ways, on a per-card basis and on an overall basis. It's best to keep both low. Having one card maxed out is a bad look, even if your other cards have 0 balances. And here's a pro tip. Your credit card company typically reports your balance to the bureaus on your statement closing date. This means even if you pay your bill in full every month, you could still show high utilization. To avoid this, you can make a payment before your statement date to lower the balance that gets reported. Lenders see high utilization as a sign of financial distress. It suggests you might be over-reliant on debt to make ends meet. Do this. Keep your overall credit utilization below 30%. For an even better score, aim to keep it below 10%. To achieve this, pay your balances in full each month, or make multiple payments throughout the month to keep the reported balance low. Don't do this. Do not max out your credit cards. Carrying a balance of $900 on a $10,000 limit card is a major red flag to the credit bureaus and can significantly lower your score even if you never miss a payment. It signals risk. Together, payment history and credit utilization make up 65% of your entire credit score. If you only focus on two things, it should be these two. Pay on time and keep your balances low. Now that we've covered the two biggest factors, let's move on to the third component, which accounts for 15% of your score, length of credit history. This factor looks at how long you've been using credit. It considers the age of your oldest account, the age of your newest account, and the average age of all your accounts combined. A longer credit history generally leads to a higher score because it gives lenders more data to see how you handle your finances over time. But what if you're just starting out and have no credit history? This can feel like a catch-22. You need credit to build credit. A great starting point is a secured credit card. You provide a small security deposit, usually a few $100s, and that becomes your credit limit. After 6 to 12 months of responsible use, the lender will often refund your deposit and upgrade you to a regular unsecured card. Another option is to become an authorized user on a family member's long-standing, well-managed account. Their good history can help you build your own. Do this. Keep your oldest credit accounts open and in good standing, even if you don't use them often. Use them for a small, recurring purchase once or twice a year and pay it off immediately just to keep the account active. The longer your credit history, the better. Don't do this. Do not close your oldest credit card, especially after you get a shiny new one with better rewards. Closing that old account can erase years of positive payment history and dramatically lower the average age of your accounts, which can cause your score to drop. And that realization is often the key to making progress. By the way, if you're finding this breakdown valuable and you appreciate this clear, in-depth approach, a quick click of the subscribe button below is the best way to let me know. It helps this channel continue to create helpful content just like this. Now, let's move on to what is arguably the most misunderstood point. The fourth factor is your credit mix, and it makes up 10% of your score. Lenders like to see that you can responsibly manage different types of credit. There are two main types: revolving credit, like credit cards, where your balance and payment can change, and installment loans, like a mortgage, a car loan, or a student loan, where you pay a fixed amount for a set period of time. Having a healthy mix shows that you are a versatile and reliable borrower. Why does this matter? Because successfully managing an installment loan over years shows stability and long-term planning, while managing revolving credit shows you can handle financial flexibility without overspending. It paints a more complete picture of your financial maturity. Do this over time. As your life progresses, you will naturally build a credit mix. You might get a student loan, then a credit card, then a car loan, and eventually a mortgage. Let this happen organically. There's no need to rush it. Don't do this. Do not go out and take out a personal loan you don't need just to try and improve your credit mix. The potential benefit is small, and opening unnecessary new debt is never a good idea. This is one of those factors that tends to take care of itself over time. This brings us to our fifth and final component, which also accounts for 10% of your score: new credit. This factor looks at how recently and how often you've applied for new credit. When you apply for a loan or a credit card, it usually results in a hard inquiry on your credit report. One or two hard inquiries won't hurt you much, but opening several new accounts in a very short period can be a red flag. It can make lenders think you're in financial trouble and are desperately seeking funds. It's a bit of a balancing act. In the short term, a hard inquiry can drop your score by a few points for a few months. However, in the long term, that new account, if managed properly, can help your score by increasing your total available credit, lowering your utilization, and adding another source of positive payments to your history. The key is moderation. Do this. Apply for new credit sparingly and only when you truly need it. If you're shopping for a car loan or a mortgage, try to do all of your applications within a short 14-day window. The scoring models will often recognize your rate shopping and count all of those inquiries as a single event. Don't do this. Don't go on an application spree. Don't apply for 3 new retail store credit cards at the mall just to get a 15% discount. Each of those applications can ding your score and lowers the average age of your accounts. Be strategic. So let's bring it all together. We've covered how payment history at 35% sets the foundation, and how amounts owed at 30% provides the strategy for day-to-day management. Then you have length of history at 15%, credit mix at 10%, and new credit at 10%, acting as important supporting pillars. As you can see, these ideas all work together to create a powerful system for understanding your financial health. To make this practical, here is your one assignment. This week, find one opportunity to apply the main principle of credit utilization. Log into your credit card or banking app and check your current statement balance and your total credit limit. Divide your balance by your limit and multiply by 100 to get your utilization percentage. If it's over 30%, your single action item is to make a plan to pay it down. And for extra credit, go to annualcreditreport.com, the official government-mandated site, and pull your free credit reports. Look for these 5 factors in action. I encourage you to share your goal or your results in the comments section below. If this is the kind of practical, detailed analysis that you find valuable, and you want to continue mastering your personal finances, the best way to support this channel and see future content is to subscribe. On Finance is Simple, we break down these complex topics into easy-to-understand actions every single week. To do that, just click the subscribe button right below this video and be sure to turn on notifications. Thank you for your time and attention today, and I look forward to seeing you again.